for lack of a nail. All right. What I'm going to do is talk. My talk today will be I'll try not to talk too fast, but keep it on time. 3 main sections. First of all, I'll talk about the underlying dynamics, the structural factors that are driving markets today. Things have changed. We're no longer in a world of structural surplus. We're in a world of structural scarcity when it comes to grains and all the implications that has for you as a protein producer. Second of all, with the help of my colleague from Europe, we'll talk, since we're in Paris, we'll talk about the situation for animal protein in Europe, the current situation, the current changes taking place, and what we might see for the future and why. And then lastly, it will look more broadly. What are the 5 key factors of change or of delta that I see taking place around the world that might be of interest to you? So with that, all right, that's not good. Page down. I needed more instructions. There we go. All right. As you can see here, while the basics of the world agricultural markets have remained the same in terms of world population growth continuing to rise and arable land per person continuing to decline, crop prices are much higher and actually structurally more volatile than they've been in some time. And why is that? That's what we're going to talk about today. We've got extraordinary demand growth from several factors. The key factor driving higher world grain prices or protein meal prices for those of you producing pork or maybe some poultry people in the crowd, the number one factor is higher GDP growth where the mouths are in the developing world, and mainly that means Asia. And while we see economic growth, GDP growth slowing down, and we'll talk more about that in a minute, these are extraordinarily high absolute levels of growth of GDP, which drives meat consumption and meat demand around the world. So that's the key factor that's accelerating demand for grain and then for meat and then therefore grain. Now, where is this happening? It's not happening in the developed world. It's not happening in Europe. It's not happening here, as you can see, in the U.S., to highlight how per capita animal protein consumption has been going down, not just in the last few years, but since the mid-2000s, and I don't see that changing. We have an aging population in the U.S. Also, the younger the person, the more interested they are in either vegetarian diets or what we would consider to be more ethnic cuisines that don't have a big hunk of meat in the center of the plate as the primary type of meal. So again, we have demand growth, but on the left hand of the screen we have protein demand growth. Actually, I think this one's poultry in the developing world, as you can see, rising very rapidly. But on the right half of the screen, you see developed world protein growth very flat. That's what's been going on for 10 years. That's what we see going on in the future. And the issue here, the implication here, is that there's a mismatch between where the demand is taking place in the developing world, right, which is Asia and which is a grain deficit region, and the grain surplus regions mainly of the Americas. So Asia will have to figure out how to import more grain or more protein, and for those of you in this room, you're going to want to export more protein to Asia. We'll talk about how China is the highest cost protein producer in the world. Now, I was not here in Paris, but I was at a similar conference a couple of years ago in Buenos Aires, and I was thinking about, all right, what has changed since then? In a couple of years ago, world GDP growth was still on the upswing since the economic financial crisis of 2008 and 2009. But the problem here in the last couple of years, and the problem or the cloud on the horizon that I see here today, is world GDP growth in decline. As world GDP growth is the key driver to meat demand, not just here in Europe, but around the world and especially in the developing markets, that's of concern. So this is a consensus estimate from Bloomberg I took a couple of weeks ago, and you can see growth for China, which obviously has a very large population and really at a swing factor in terms of where the income growth drives meat demand at an accelerating pace. You see growth there decelerating from over 10% to, in this case, 8% But our people in China, no one there in China thinks growth is going to be 8% this year. It's going to be probably, let's hope, 7%. India, 6.9%. It's really probably, as we sit here today, closer to 6%. Brazil, I was in Brazil last week. The consensus there is not for 3.4% GDP growth in Brazil, probably actually less than 3%. So if there's a cloud on the horizon for you in this room, it's world GDP growth slowing and therefore meat demand slowing, and you matching that demand for protein with what, as best you can, with what you pay for either your inputs of either corn and meal or the livestock. Okay, so protein prices have stayed high. Cattle prices, pork prices, chicken prices in general have stayed quite high lately, and the answer is really still quite simple. As you look back over 6 years ago, world GDP growth is up 35%. Over that same time period, beef, for instance, beef production isn't up at all. That's pretty simple. Beef prices are going to be quite high. So we have what we call the choice cutout in the U.S. was $1.97 or $197 a hundredweight last year, knocking on the door of record levels. So as GDP growth outpaces protein growth, prices are strong. It's really that simple. And for most developed markets where people have developed a taste for meat, declines in income growth does not tend to mean declines in protein consumption. There's very little elasticity there. Now, what's the second factor? The first factor driving protein demand growth was GDP growth. The second is how we're growing that production. Here in China, for instance, elsewhere in the developing world, mainly across Asia, also in places in the South America, it's the industrialization of protein production. Animals being produced in confinement rather than backyards where they eat table scraps. If you've got 5,000 hogs or sows that you're trying to raise, you can't feed them table scraps. You have to move to feed-grade wheat or corn and soybean meal. There's very little substitute for soybean meal out there. So this is a second factor driving feed input costs for the animal protein industry and therefore the grain and oilseed markets. The third factor is biofuels. It's corn in the U.S., which is taking over 40% of the U.S. corn crop. I think the political bloom, if you will, is off the rose for ethanol in the U.S., but we've got to watch that. And biodiesel for world oilseed demand. I guess rapeseed, biodiesel takes 70% of the rapeseed crop here in Europe, but about 40% of world vegetable oil growth now goes for biodiesel. Some of that demand growth is slowing in certain parts of the world, here, Asia, but biodiesel demand is growing in South America at a very good clip in Brazil and Argentina. Whoops, that's the wrong one. There we go. All right, so while we have demand growth for protein rising, right, for three key factors, at the same time, growth of crops is decelerating, right? For many decades, crop productivity was rising faster than demand. So we had structural surpluses, which caused the EU to create the Common Agricultural Policy, for the U.S. to create the farm programs. But now we have structural shortfalls. Part of that is the accelerating demand. Part of that is also declining productivity. We've done a couple of interesting pieces at Rabobank this year. One is that we believe very much USDA is overstating trend line yield growth in the U.S. corn. The USDA is using 164 as trend line yield. Lately, their estimate is 166 bushels per acre. We think the trend line yield is really 155. We're going to have another piece coming out, if not later this week, next week. We call it Nature Finds a Way. With all these GMO crops, genetically modified crops, that's leading to resistant weeds to, namely and particularly glyphosate, and it's causing big problems for farmers with corn and soybeans, and that is causing yield reductions as well. So we've got some challenges there in crop production keeping up with demand growth. Another factor is you look at different countries around the world, Brazil having a hard time keeping up with demand growth, mainly because of infrastructure problems. Not just Brazil, but Russia as well, not really building out infrastructure as fast as demand is growing. Russia, while Brazil is certainly the incremental producer of oilseeds around the world, Russia has become the incremental producer of grains around the world. About 12 years ago, Russia was producing about 5% of world wheat exports. Russia, Ukraine, Kazakhstan, this last year with a recovery in production, 25%. But it's still an important swing factor. Wheat production in Ukraine and in Kazakhstan this year we're down about 10 million tons year over year. So it's a very precarious area for the world to be depending on. And even when they do have a big crop, like last year, they can put on export bans on grain, which does not give the world's grain importers much comfort. All right, now with all this, with these big moving factors of demand acceleration, productivity, deceleration, what's the net of it? Well, the net of it, using USDA's estimates, is that even assuming a huge rebound in U.S. corn production this year, and after a reduction in South American soybean production last year, a big recovery there, USDA's estimate for world grain ending stocks a year from now moves up only 2 decimal points, 0.2%. So even if we assume we have good crops around the world, we're not really getting ourselves out of this no margin for error situation. So that's why whenever we see a situation in the markets where it's a little too hot and too dry in Illinois or a little too hot and too dry in Ukraine, the grain markets take off. We have not built a comfortable level of stocks. Also, when we do have a dip in crop prices, China steps in. I've covered China in different presentations. I'd be happy to talk about China with any of you offline. We have a time challenge today. But China is structurally deficient in producing its own crops. China was not an importer of corn for over a decade until this last year, 5 million tons this year. In May, China set a record for soybean imports, 7.2 million tons. China has a problem. It's going to keep driving world markets, whether it's for pork, corn, soy. So as you drive those stocks-to-use ratios down, as I showed you in the last slide, what happens? Much greater volatility to minor changes in supply or demand. The blue line is changes in supply or demand. The red line is change in price. Another factor is that managed money. As managed money moves in and out of these markets, managed money has really come out of these markets in recent months. If people think there's going to be, if the fund managers, the commodity fund managers, macro managers think we're back to the races, it'll flow in and exacerbate the uptrend. Let's talk about Europe. We're here in Paris. We're enjoying steak frites and vin rouge. But lately, protein prices, animal protein prices have been strong in Europe, whether it's pork or beef, and that's been driven by exports the last couple of years. But the issue or the question, and that's driven the higher prices, strong exports, strong prices, as you can see from this slide. But the question is, all right, how sustainable is this recovery in pricing? Well, as you look from 2000 to 2011 in pork, per capita consumption is down about 8%. In beef, it's also down over the past decade. Though you see pork exports are up on a longer-term basis, beef exports are down. But let's look to the future. If Europe is going to depend on protein exports, what's going on here? Well, we've got some changes in the regulatory regime. We have a situation with the dairy quotas coming off, the abolition of these dairy quotas. Countries that were hindered from producing more milk are going to start producing more milk, and that's going to displace beef production. So we believe that for the most part in Northern Europe, dairy production will go up, beef production will go down as the pasture land goes to the higher and better use or the higher return. We think the quality beef production, cattle produced with the intention of producing beef, will shift south towards our friends in Italy, for instance, in some regions of France. Also, we have changes to the Common Agricultural Policy that will tend to both reduce and shift where beef is produced here. Payments are going to shift, as you would well know, from being based on historical production levels to a flat rate, which implies an overall reduction of subsidies. You reduce supports, production tends to go down. That's pretty simple. There's also a redistribution of these subsidies from so-called old to new member states. Plus, they're shifting toward environmental based policies that will tend to reduce beef production, we believe, as well. Let's talk about pork. As you see on the left slide here, when we compare on the left Brazil, Canada, the U.S. to various countries in Europe and the EU average, the Americas have a grain cost advantage, labor cost as well. And so you see the Americas are about one-third, we believe, one-third lower cost in producing pork than Europe. Well, but lately, obviously, with volatility in exchange rates, what does that mean? Against the U.S., we think the EU is fairly competitive with the euro below 125, where it is today. So that has certainly helped EU pork market, export market competitiveness. But the Brazilians, with the real now below 2 relative to the U.S. dollar, Brazil is a lot more competitive as their currency has devalued lately. Pork industry trends, as you all know, many of you would know anyway, the EU is implementing new environmental and animal welfare regulations across the member states next year that will further increase the cost of production for pork across Europe, decreasing Europe's competitiveness in producing pork, and probably, in our view, reducing production and reducing exports over time. Europe may not be much of a pork exporter in 5 years' time. Also compounding the factor is that pork producers in Europe have not made much money over the last 4 to 5 years. So if you're thinking, there's not a lot of equity across the industry to make these investments to satisfy the new regulatory regime, so that compounds the challenges for EU pork production. So to conclude our sunshiny segment on Europe, it's been a bit better lately, the last couple of years. Strong exports of beef to Russia and Turkey, of pork to China and South Korea. But high feed costs are a competitive disadvantage here. And on the sell side, the concentration of retailers by country limits pricing power. And as we look forward, new regulatory regimes affecting pork and beef will increase the costs and challenge the competitiveness of the industry across Europe. So world meat demand is rising, mainly in the developing world, but it'll be a challenge for that to be satisfied from Europe. So let's close with 5 key thoughts on we see an increasingly globalizing animal protein industry. As I talked to companies in China and Brazil last week, the U.S., what are they thinking about? What are we talking about with them? One is that labor rates are changing very rapidly. For better or worse in the U.S., wage costs are not going up. That's good if you're an employer, not so good if you're an employee. But relative to animal protein producers in Brazil or China, well, namely China, labor rates in China have been going up 20% per year for over the last 10 years. And so China is a high-cost producer of animal protein, both from a cost of the feed inputs perspective, but also increasingly from a labor perspective. The regions on the east coast of China are increasingly finding it difficult to obtain a quantity of labor, also a quality of labor, and production is shifting to the interior. It's becoming a bigger challenge. Now, it's not all bad. Whether you're in China and Brazil and labor costs rise, that it creates demand from those laborers that are getting higher incomes. They can buy more meat. Second, cost of capital. And here I compared the U.S. with the Brazilians, mainly because the national champions of the world are the companies that have been expanding most across the world until the last few, maybe 6 months, have been companies like JBS and Marfrig, Brazil Foods a little bit, but the cost of capital, even with government-subsidized capital in Brazil, U.S. With the cheap dollar policy, the quantitative easing, still has a big cost of capital advantage. Third, currency. It's fairly self-explanatory. It's fairly clear. As governments around the world try to keep their currency relatively low, relatively cheap to others, it can shift things. It's one thing to be high or low. The challenge for companies that are exporters, want to be exporters, is the constant volatility. If you're in Brazil and you have a 1.5 real to the dollar, you're certainly not competitive. If you have a real of 2 or more to the dollar, you're certainly competitive. Okay, two more. Price of pork in China. The pork in China is the biggest protein market in the world. China is not a big buyer or seller of pork, but it tends to affect world markets. And you see Chinese pork driving Brazilian poultry export prices. There's an interesting link there, though not always logical. We think China has protein being very expensive in China. We think that costs have risen to such an extent that hog producers in China are now losing money, and that pork prices by the end of the year will be rising again, providing a bit of an umbrella for all world protein prices. And there's that forecast. So with that, I thank you all for your time and attention today, and I turn it over to my colleagues. Thank you.
Thank you, David, for an excellent presentation, an excellent overview. I hated to rush you, but I think you came in pretty well on time. Our second speaker this morning is Christophe Laforge, who is Senior Director with the food and drink firm JIRA. And JIRA, of course, is well known, I think, to most people in the IMS. And since joining JIRA some 20 years ago, Christopher has worked on many assignments, particularly here in Europe, but he's also done international studies on both meat and the other proteins. His most recent work has included a review of the pork markets worldwide and exports and the outlook for the European catering markets. His topic today is, are we moving towards a world price for meat? Christophe, you have 20 minutes now.
Yes, good morning, ladies and gentlemen. Yes, as you just said at the beginning, my real presence here is just to prove that JIRA is not a one-man operation. And as you know, with my colleague, Richard Brown, and as you can see, I'm following really the same path as him, and so it's going to be easy to recognize ourselves. I need to click a button, or I need to finish the Rabobank presentation. I will continue. No.